So no surprise, we're talking about the budget. I don't know about you guys. I assume we're all experiencing the same thing. I'm getting a million people reaching out to me about
Absolutely, yeah.
changes, what the implications are, what do we do going forward, when do we get affected by these things. So I think this is probably the best way to just kind of nut some of that out.
Yeah. Also, I think a lot of the fear-mongering that we saw beforehand may have been overblown in some of the ways that some of the changes that we've seen are not as bad as we thought they were going to be. In other areas, they're like, just what they said they were going to be.
Yep.
And so it's just about picking through kind of what's where.
Yeah, understanding myth from fact.
That's right. I think the first thing that we have to talk about negative gearing, because negative gearing is going to be one of the big hot topics, because negative gearing isn't going to disappear completely, but it is going to be completely different.
Yep.
So I'm going to use a simple example so that it is easy to understand. So firstly, this doesn't kick off until 2027, which is the 2028 tax year. So it's another year and 2 months before the tax year begins. And from that point on, if you buy an established property, in fact, if you buy an established property today, this is the tax rules that you're going to be following come July 1 in a year's time.
So if I buy a property today that's established, if it's not PPOR, it's
Correct.
in my name as an investment.
Correct.
The changes will affect me. I'm not going to be grandfathered in, because I think that's a big thing people are asking.
Correct. The grandfathering in it comes from last night.
Yeah.
So now that we're but if you hold the property at the moment, there's no changes. So to give a quick example, so let's say you buy a property and it's generating $25,000 a year rent, but your mortgage and other costs amount to $30,000. So you're making a $5,000 loss on that property. Now, in simple terms, at the moment, if you earn $100,000, you would just deduct that $5,000 off, say that you earned 95, get the tax back on that $5,000, which would be about $1,500 you'd get back in tax. Now, for the tax year 2 years' time, you won't get that. But you don't lose it completely either.
So now we're talking about end of June 28.
Correct. So when you're doing your tax returns in kind of July of 28, so in kind of 2 years' time, that's when you're going to look and say, well, I made a $5,000 loss. What do I do with that $5,000 loss? Well, what you do is you carry it forward.
Yeah.
So instead of getting $1,500 tax back, you just go, I'm going to put that in a line marking, carry it forward to the next year. Now, maybe the next year, the rents have gone up. So now your expenses are still $30,000, but now your rent is $30,000. And so you have no tax to pay in the 2029 tax year. And then then your rents go up again, and your costs are still $30,000, but now you're getting $35,000 rent. So now you're making a $5,000 profit. What you'll do then is you'll use up the $5,000 that you carried forward. So instead of paying the $1,500 on that gain in 4 years' time, you don't pay tax on that gain. So it doesn't lose the tax deductions, it just delays them. And so that means you've got to wear the cost in that first year and suck it up.
And then if we extrapolate that to year 5 and 6, then there's going to be no benefit to it. You're going to be...
Again, there's no difference between currently, if the property's making profit, you pay tax on the profit at your marginal rate.
Yes, but you won't have anything to carry forward.
Correct. Yep. So once you've used up the carry forward, the logic for this, which Christian you'll be familiar with, is the imagine two people, Alex and Ben, are earning $100,000 a year each. One of them chooses to invest in property, which loses money. Well, at the moment, if he buys a property that loses $5,000, he's going to pay less tax than his colleague Ben, who chooses not to invest in property. That doesn't feel fair to Ben. It feels great for Alex because he's investing in property, but it feels a bit shit for Ben.
Yeah.
Whereas under the new rules, Alex and Ben both earn $100,000. They both pay tax on $100,000. If Alex's property loses money in the short term but makes it in the long term, then overall he'll be better off because he made money on property. He just won't be able to claim the tax deduction in that year.
Yeah. So it's arguable to say if you're building a portfolio, you wouldn't necessarily do it all in your name. But going forward, that's definitely not going to be the case.
Yeah. So while you talk about building, as soon as you said building,
New builds.
of new builds.
Yeah.
So new builds can still get a tax deduction from. Is that right?
Yeah, that's correct. So
Yeah.
all new builds will still receive full negative gearing benefits, I believe, until you dispose of the property.
Yeah.
I mean, that's a great scenario for what I do. Buy something existing in a relatively short period of time, you end up with a brand new property. So that is now almost a gold mine if you are wanting to do this in your name.
Correct. But of course, the way that we do things, which is to try and keep all the profits with the person that's doing the development, it's brilliant. But think about the rest of the industry, where you've got spruikers building shit properties wherever they want, and then flogging them now to people. Oh, negative gearing. You get negative gearing on this. Whoa, look at this negative gearing. And you know they're just going to be selling dog shit properties to every man and his dog. And that's where, our aim is to try and give you the developer profits, whereas this is just going to encourage even more developer profits going forward.
Yeah, not all new builds are equal, not all developments are equal. Location, what you're building, the quality of it.
Yeah.
So that still needs to be taken into consideration. It's something you should be considering prior to this announcement anyway.
Correct. I just think it's going to encourage the spruikers. It's like, we've got something special. You buyers agents, you can only buy old stuff. We've got the new stuff. So it's yeah.
It's going to be interesting to see how it ends up.
Yeah. But yeah, I guess it's worth mentioning. So obviously if you have property from the budget last night, you still get full negative gearing benefits.
Correct.
Still disposed of. If you buy between now and June 2027, you still get to deduct for the 26-27 year,
Yeah.
but not afterwards.
Yeah.
So it's a bit of a soft landing. But to be honest, for us in the room, it's negative gearing is not something we've ever really considered in our investing, and it's not a strategy we've ever tried to employ.
We sometimes benefited from it, but it's like, if you're investing for negative gearing, you're in it for the wrong reasons. You don't understand money properly.
Yes, yeah. Getting a tax break because you can't afford to hold your assets or getting help holding them is not a good
because you're
structure.
losing money in the short term. It's if you're losing money in short term, it's because you want to make money in the long term.
Yes.
Yeah.
Can we pick up though on the borrowing capacity calculations, because I know you've done some work on this, Christian?
Yes, I have. It's a very basic calculator, but you can see up there I've got the tax rate 32.5, which to be honest, I'm going to assume the majority of Australians land in.
Yeah, which is any income between 45,000 and 135,000.
Yeah, and I've assumed a purchase price of $1 million, which is actually probably a bit of an earnest investment purchase price. Not if you're in Sydney or Melbourne, but not if you're in Brisbane or Adelaide either these days, apparently, or Perth. So maybe $1 million isn't that bad a point. So we've assumed $1 million purchase price, $800K loan here on a 6.6% rate. Now, that would land you with an interest bill of about $52,000 a year. In terms of the rent you receive, that would be normally 40, as you can see there, on a yield of 4%, you would get about $40,000 a year, or once you take out the roughly 20% for costs, that's about $32,000 a year.
Yep.
The 32 is the net rent there.
Oh, okay, got you. So the 32 minus the 52 is a negative 20,800, and under the current rules, you would get $6,760 tax back.
That's correct. Now I've had to do a little bit of back maths, but basically, assuming you can borrow about 6 times your gross income, that figure lands you at about $60,000 of borrowing capacity that would be lost.
Yeah, okay, so because the bank calculators take into account that 6,700 currently, you not only lose it from your income, but you lose it from your serviceability. And so suddenly you can borrow $60,000 less, and that might mean you can't afford the $1 million property, you can only afford $940,000.
For reference, I've also thrown in the 1% cut to the lowest second lowest tax bracket, and that makes about $2,300 difference a year. So,
I mean, those numbers, 60,000 and 57,000, that's not a small difference.
In borrowing capacity, yeah, and that's just from this alone. And you've got to remember that we've also been smacked by 3 rate rises, which have also had a similar impact in terms of borrowing capacity. So if you had someone at the start of the year that had a borrowing capacity of $1 million, there's a really good chance that by now their borrowing capacity is closer to 800. Sorry, that's a borrowing power there of 800. That borrowing power now is probably closer to about 650.
And I guess this is one of the things I harp on about when I'm talking to people is taking into consideration the affordability of where you're buying. Considering getting smashed with rates and now these changes, some areas may stagnate.
Yeah.
If people can't afford, or the average person can't afford to borrow more than what they're already going for, you might even see a bit of a downturn.
But wait, it gets scarier. You've always got to challenge the assumptions, and here we're assuming that banks are logical in their approach and will apply the changes in a way that actually makes sense. But what do we know about banks, Max?
Mate, sometimes the people at the banks understand things, but then they brief their techies and they've got no idea. And they say the techies, we need to change our calculator so we remove negative gearing. Now, the problem is some bank calculators, when they remove negative gearing, they don't remove the 6,760. They remove the $52,000 from the deductibility. In other words, they'll say, hey, listen, you're making 32 grand in rent. Now you have to pay tax on that rent at 30%. And then we'll deduct the mortgage after that.
And that's a calculations error.
So it's bad maths, but I'm telling you now, we have lenders. So if you work for any of the banks, can you please make sure that your IT people understand the difference between negative gearing and tax deductibility, because some of your calculators are currently built to remove tax deductibility, which is to remove the $52,000 figure.
So change that one. Change that 1 over to a 0, and we'll see how bad the impacts are.
Where's the 1?
On the M line.
Yep. Oh, okay. Yeah, that's yeah. Okay. That's $152,000 difference in borrowing power.
Oh,
and that's just simply a bad maths. But we have lenders right now whose calculators, if they just simply flick the switch over, will give you $150,000 less borrowing. And they won't be able to do anything about it until they change their calculator.
Do you think this is going to be, a few months of issues where they're not catching up on this?
Yes. But by experience, after 17 years of seeing changes in banks, some banks have got great IT systems and they'll do it beautifully and they'll integrate everything and it will work perfectly. And then there's all the other banks that are not CBA and Westpac.
So markets can see a downturn, a stagnation, and without any context or without knowing this, which a specialized broker really only knows about, you might be completely reading that market incorrectly.
Correct. So and that's another reason why talk to a broker. And obviously, we're brokers that are also investors, and so we're looking at it from all aspects. And it just means that when we see a lender calculator that's screwed, we just can't use that lender unless your servicing is amazing. But in this example, you could lose 150 grand of borrowing power. $100,000 of which, $50,000 which is down to the government changes, $100,000 of which is just an IT error.
Wild.
Yeah. I think that might actually be one of the biggest shocks if we have a look, how out of whack is borrowing capacity in Sydney at the moment? I know you've been looking at the numbers.
Certainly. I mean, I've been tracking borrowing capacity for the last 50 years in Sydney versus house prices, and every time there's a rule change, then borrowing capacity shifts. Generally, that it's shifted upwards up until 2016, and then borrowing capacity shifted downwards, and then it shifted downwards again with the rate drops of 2021 and hit a peak. We are not yet back to the 2021 peak, so we dropped below that, but Sydney prices are significantly above the 21 peak. So the prices shifted when we could borrow more, but they've carried on shifting even though we can't. So we're now in a situation where we're way down in what we can afford to do, and yet the market hasn't responded. So I'm very nervous about the Sydney property market, or particularly Sydney houses, and especially anything priced over 1.5 million.
Yeah, I mean, we've seen event after event where we should see a downturn or a slowdown in price growth, and it just doesn't happen every time. I think
it's happening. So right now, what's happening in Sydney is that we got house prices priced above 1.5 million are currently in decline. Before the last rate rise, before the budget announcement, okay, they're 3.5% down. However, under 1.5 million, 1.5 is key because that's where you get the first home guarantee benefits. Under 1.5 million is up 6%.
yeah,
which is that nuts, is that split in the market. Now, if you're buying over 1.5, particularly over 2, even up towards 3, you're going to be on a much higher marginal tax rate. So do we just want to quickly whack in that 32.5 up to a 47.5?
So that's for people earning over $190,000.
So,
So yeah, if your tax rate's 47, you've lost $110,000 worth of borrowing capacity as a result.
That's not right.
this has gone down from the last calculation.
Well, that's because
it was
we've got
52 before. It's gone up to 100,000.
It was showing 157 before.
Because that was when that's the bank error.
Oh, so you're not showing the bank error in this instance.
Yeah. So I'll go to the bank error again in a second. You'll see that's like horrific. So assuming the bank calculators work correctly, then borrowing capacity for someone earning over 190 grand has dropped by around $100,000 in this scenario, versus 50 for someone on the basic rate. And of course, if the bank calculators are stuffed, which we know some of them are, then you've just lost 280 grand's worth of borrowing power, starting from 800. So it just means that you're now down to 520.
So you're either reassessing what you're going to purchase for, or you've got to come up with another
or you're
couple
talking to a broker and go,
$100,000.
hang on, we're not talking to them. But even then, if this drops from 800 to 690, so if your max borrowing was 800, it's now 690 if your income is in the top bracket. And that's as of anything you buy from today onwards, because the bank calculators are going to have to rip that out pretty soon.
Yeah. I thought we weren't going to fearmonger.
Well, I mean, we're not buying stuff in our name over 1.5. It comes down to strategy.
Yeah, it does come down to strategy.
Yeah, but then you see, we own property in trusts, and trusts were part of my long-term plan. And part of my long-term plan is that when I retire, the trusts become my major source of income. The other thing is that there's a minimum now tax rate of 30% on discretionary trusts from the 1st of July, 2028.
Who's being taxed in that scenario, Max?
Well, it's actually the trust that's going to pay the 30% tax as if they were a company, which is bizarre because now the trust has got a higher tax rate than a company.
Yeah, under $50 million, yes, of revenue.
Yeah. So now the trust is going to pay 30%. Now, if they distribute their profits to an individual, the individual may get the credit for that 30%, but only if their tax rate is higher than that. So in other words, if their tax rate is 47%, then they will pay the extra 17. If their tax rate, though, is 0 because they're not earning, which is my plan for retirement, was to hold property like this that would become my source of income. So if I've got a property giving me 40 grand a year worth of income, in retirement, I thought I was going to be paying like 4 grand's worth of tax. Turns out I'm going to be paying 12. So I'm going to have to try and move that property into super or do something else or sell it before this kicks in. Because this is not grandfathered. So we've got 3 years to make the changes because it starts from July 28, which affects the 2029 tax year. So we've got 3 years to maybe tweak things, but this is not grandfathered. So the properties that we bought in trust 10 years ago are going to get hit by this 30% tax.
Yeah. So just to clarify, the trust is going to be taxed at the 30%. If you're using a company that's making over 50, it's 30, but it's under 50 million, it's 25%. Is that correct?
That's the company tax rate.
Yeah. So company tax rates
two.
for most people who are going to be listening is paying 25%.
Yeah.
They people keep touting the 30% tax rate. That's for big businesses.
Yeah.
Golden Eggs as a business pays 25%. Westpac pay 30.
Yeah. Just to circle back, we're talking about the negative gearing still applying to new builds and how that's beneficial for what I do, but incentives for new builds, what are they, and how does that apply to potentially developing property?
Well, they've mentioned that they're going to be putting, I believe it is, 2 billion towards councils and helping councils speed up the process of development.
Sorry, by the way, I have to chuckle at the $1,000 instant tax deduction.
Oh, I know.
So the reason I chuckle at this is because this is so geared towards high income earners. It's not funny, because currently you can write off $300 without any receipts. Suddenly it becomes $1,000, so everyone's just going to take the $1,000. But that's $1,000 off your income. That means if you're earning $191,000, your income drops to $190. You just saved yourself $470.
Yeah.
Whereas if you're earning 20 grand a year, then writing off that $1,000 is going to save you $140. Yeah. So they could have just simply raised the threshold at the bottom end. It would have helped everyone by the same amount, but that's proportionally a bigger thing for.
Not that I want to get into it too much, because there's plenty of people out there talking about it and it can be divisive, or not that I think it is, but the aim of this budget and what they said they wanted to do with it seems to be completely the opposite of the effects that these changes are going to have.
I think it remains to be seen.
Well, the aim from what they said was to help basically equalize investing. It seems there's really not much that's been done to help people get into property as first-time home buyers, or even people in smaller scale portfolios.
Yeah, I think the hope is one or two things which I think will have a very limited impact. Is they're hoping that the market for developing properties grows, and that developers take on the burden of building properties, and that there is offloading of investment properties by long-term investors.
Right.
Will that relieve the supply of houses that we drastically need? There might be some small changes, there might be some help, but I don't think it's gonna overall drastically change the picture.
Yeah, and I need to look into it more, but that $2 billion that's going to council for water and
I've just sent
services.
it to you on Teams, Max. If you open up supporting local councils, I just sent you a link. So this is where we are. So infrastructure to support up to 65,000 homes nationwide over the next decade.
So firstly, let's do the maths on that. 2 billion divided by 65,000 is $30,000 per property. Okay. You're already shaking your head because it's just a drop in the bucket. Now, in reality, if the way that they're going to do this is to help fund the utilities, which is currently a cost borne by the developer, when they've got to do the connections to new sites, then as soon as you give the money to developers and hope that they pass it on to end consumers, we know what happens.
Yeah, I noticed that they were also talking about $3.6 billion that would be given to local councils for them to spend on what they prioritize. So
no, that was $750 million. The 3.6 mil is going.
$3.6 billion in untitled funding under financial assistance grant program, which local government can spend on their own priorities. Sorry, not council, government.
United funding. Yeah.
Yeah. I mean, if you go back down to
so that's to do things like that. The state government's putting in place the $10,000 rebates for first home grant, that kind of thing.
Right.
So, but it's up to the states to choose their own method and calculation and how they apply it. But nevertheless, it's still going to be a relatively small number, because we know that numbers are not very big relative to the.
If you scroll down to what we were just looking at, which is the 2 billion, where is it?
Yeah.
So it says utilities build the critical last mile infrastructure needed to support new housing development. So what this means is this money is going towards creating new developments on the fringes of city. That's what the last mile is implying. So what the supply is going to be, or where the supply is going to be created, is basically as far as you can get from the center of whatever city or town that this is going into. So that could be
Picton.
Picton, you could be almost at Wollongong down through Campbelltown if we're talking about Sydney. So the supply being available for people is important, but where? Is it somewhere that people want to live? Is it going to create congestion?
Unlikely.
Yeah.
Yeah, it's very small amounts of money spread out over very large areas, and predominantly it's going to end up in more supply in way out places, if at all, and it's also going to help fund developer profits, because developers will still sell at the price that the market will bear.
Yep.
So the only place that that any form of affordable housing becomes affordable housing is when it's donated to local councils, who then rent it out at what they believe is a fair rate to people that need the housing. And so a successful project was done like this in Burwood, where a developer was allowed to build an extra story on condition that they gifted the local council something like 15 apartments. Now, those 15 apartments are now owned by the council. They can rent them out to whoever they want, and they are affordable housing in terms of rental affordability for those people they rent to. But that's only done on a very small scale. And unless that's done so that we end up with more public housing, we're going to struggle. Because making housing affordable, at the end of the day, builders and developers are going to charge what they can. The only way to do it is really to wreck the market. And if you wreck the market, well, then the people with existing houses struggle.
Well, the only real way to help people get into property is by that property being cheaper.
Correct.
But to purposefully create a downturn in property prices is never going to happen. Everyone who's invested up until this point would be up in arms, which would be the majority of people. And really, it's this generation coming through that is really, kind of left out. So the majority, there's no way that they would let that go. So that's why you see changes like this that, they say will help, but in actuality, it doesn't necessarily.
I want to come back to capital gains.
Yeah, that's what I wanted to say.
So there was a lot of discussion around capital gains. And they were talking about axing the 50%, calling it 30%, or making it 25%. None of that's happened. Instead, they've gone back to the original capital gains tax, which is where you only pay tax on the gains above inflation. So I've got an example here. Supposing you looked long-term at property that you hold for 24 years, the property market grows by 5% per year. And you start with $1 million property. That means in 24 years' time, that property is worth $3.2 million. Okay. Now, if inflation over that same time is 3%, well, then your $1 million property would have been 2.03. So your capital gain is actually 1.19. Under the current rules, your capital gain would simply be 3.2 minus $1 million is 2.25. And you'd pay tax on 50%, which is 1.12. And look how similar together these numbers are. So if you're holding property long term that grows at an average rate, and property over the long term has been about 5%, then the difference is negligible. Where the difference becomes huge is if you happen to get lucky by buying in an area that's grown by 15% over the last 3 years. And that's where we would see a massive difference, because 15% over 3 years, it means your $1 million property is worth 1.5. Inflation's only 1.09, so you would pay tax on 428.
So, doesn't this defeat the
under
purpose?
the old rules, you would have only paid tax on 260.
So doesn't this defeat the purpose of trying to open up supply by potentially making long-term investors that have been holding property for a long time sell through some of these other changes we were just talking about? This blatantly shows that you should not be getting in and out of property and potentially opening up supply.
Yeah, that's the risk. So the reality is, anyone that currently holds it, these rules are grandfathered, so that I believe.
We have
the choice, don't we?
No, so how it should work is once the changeover happens, so we're being recommended to get valuations done before the change.
That's right. It's for gains that happen after
will be index based.
Yeah. So the gains prior to that you'll get the 50% discount on, and the gains after that will be indexed. But it means that anyone buying a new property after that date doesn't have the choice. It's just whatever the gain is over that time period. But once again, some developers do very well by subdividing, turning one house into two and then making a profit, but they're going to lose a lot of money in tax now, compared to the proposed cut to a 35%, to 30% or 25% capital gains tax discount, they're going to be much worse off.
And that comes down to strategy. If you're a developer that is doing 10 townhouses and you have to sell them all to get your capital to do another one and make more money, your hand is forced. You're just paying that extra tax and you've just got to keep going. So developments, we look at all sorts constantly to make sure, what we're doing is still good. And if there's another option that is better, those margins are so incredibly tight right now.
Yeah.
Build prices have gone up. They've come back slightly. Now, some things are going back up again, but the property prices hadn't quite caught up with that. So not only are builders' margins low, the developers that are paying the builders and the trades and buying the land and turning it over, what's their choice to make more money?
Yeah.
Price them higher?
Yeah, price them higher. Yeah.
Again, defeating kind of the purpose of all of this.
Yeah.
Which seems to kind of be the end conclusion with most of it that we've read through.
Well, that's the risk. Is a lot of it makes it worse off. From our perspective, the way that we do things makes our strategy look gold, because buying an old house, building in the backyard, and then selling off the front house, we know that the capital gains is pretty low on that front house anyway, relatively speaking, and the changes don't make a huge difference to that. But then our plan is to keep the nice new house for longer. And there is no benefit in capital gains tax for new housing. It's just, it is what it is. But it means that house can be valued at the time it's finished and then will be indexed from there on.
Yeah, I noticed there was quite a few markets that kind of slowed up into this announcement, and speaking to some of the people that we were still actioning things for, having these conversations, that this is a great time to take advantage.
Yeah.
We got a few under contract and we've started these developments. I mean, for this news to come through, unfortunately not necessarily great news for everyone, but it's put us in an incredible position.
Yeah, I mean, they say make hay while the sun shines. And at the moment, we've got sunshine for the next couple of years. We should definitely try and make hay.
Yeah, well, I'm very glad that a lot of my clients are going through you guys, because it means that the calculator is definitely right and we can take advantage of potentially this bit of a clusterfuck effectively for the next few months.
Yeah, that's right. With the next, we've got until 1st of July 27, which is the 2028 tax year.
Oh, I'm just talking about the banks working out their calculators. In the short term, if you are speaking to anyone and all of a sudden you're falling on your face with servicing, that might be the issue, and they haven't even caught on to it because they're sitting there, they're getting a calc from someone else or another department who's not doing what you guys do, which is being absolutely on top of everything. I mean, we've been talking about this nonstop for 12 hours.
Yeah,
I was sitting there at 8 o'clock, 9 o'clock at night. We started talking about it. I had to go to bed because it would make my head spin.
But the reality is, it's not just the real impacts. It's also the unexpected impacts, which, like we said, is just simply errors. And this is not going to be a case of bank error in your favour. That would be a bank error against you. And if you've got your bank telling you your borrowing capacity has just been axed, then you've got to talk to a broker and find out if it has been axed across the board, or if there's actually intelligent banks somewhere which have got proper calculators that work it out in the correct way.
Now, we are out of time, but I would really love to pick up the conversation again about the trusts being taxed at 30% and whether or not we should be considering different structures.
Yes, I am also very interested in talking about that.
Yeah. So, well, it's an interesting one, isn't it? Because the trust itself gives you, if it's a discretionary trust, you have the option of moving money between different entities or whatever. So the benefit of discretionary trust is that you get to choose who gets the benefit. Now, having that 30% tax just says, well, okay, it's 30% tax, but then still, do we want to move the profits into an individual or a company? Once you go down the company route, then everything is 25%. There is no long-term inflation adjustment. And so it will come down to project by project. Does it make sense to, and again, going back to that question about, will developers be hit hardest by the capital gains tax changes? Probably not, because the ones that are doing it through a company, they'll just do it through a company. Their tax rate's 25%, no biggie. But yes, it does. It will raise the prospect that some properties, depending on the length of time we're going to hold them, depending on what we're going to do to that property, it may be better to put them in a company rather than in a trust. The company still has the opportunity to distribute to shareholders, but it must distribute to shareholders according to your shareholding. So you can't just go, oh yeah, well, I'm going to give myself half the profits and I give them partner half the profits if the shares are currently 10 to 1.
But you can just dilute those shares before you make a distribution.
Again, we should always get advice from an accountant.
Yes.
But it means that we are going to have to get advice from accountants on doing this. All I'm saying at the moment is it will raise those questions again, and we should look at it again as to see what impact it's going to have. And it will be a case by case. It won't just be a question of, oh, this is no good anymore. It'll be a case of, well, what's your long-term plan and what are you trying to do?
It sounds like more than ever having a clued-on broker, a clued-on buyer's agent, a clued-up accountant is more
Absolutely.
important than ever.
Especially in the next 3 years.
Yes.
Where the world is changing.
Yep. Beautiful.
That's brilliant. Thank you so much. That was a great conversation. I really appreciate that.
Yeah, absolutely. We should do it again.
100%.
Listen in.
Yep.
Subscribe. Do whatever you need to do.
I'm going to refrain from saying anything that needs to be cut out. Goodbye.
Bye.